This is our fourth iteration of the CECL Roundtable, and while the first three really focused on preparing for CECL, implementation for CECL, good tips and tricks for CECL. Given that we're now 6 months into the year and CECL was technically required to be adopted 1/1, we felt it was a good point to check in and sort of say, okay, where do we stand with CECL? We've implemented it. Now what's next? What's gonna occur? What should we be looking out for? What should we be taking into consideration? What should we be working on now? So for those of you that are unfamiliar with me, my name is Kevin Rohde. I'm an insurance partner here in the Rochester, New York office, and I work primarily on financial institutions, larger financial institutions in our practice. I'm sure everyone on the call probably knows Jamie, so Jamie and I will be presenting today. I'll do the first half, and Jamie will take the second half. Followed by that, we have some submitted questions that people had sent to us over the past several weeks, and we felt they were good, questions that cover a lot of things that people are wondering. So we'll talk about those. I will say, while we do have a prepared slide deck, we like this to be participatory in nature. We really understand that when it's just us up here droning and on, eyes can glaze over, and we really think that the purpose of these roundtables are sort of to see what others are seeing, hear what others are experiencing, and get input along the way. So, I don't mind whatsoever. You don't need to save your questions to the end. If you have a question on something we're talking about, feel free to just speak up and we can chat about it. And, I won't lie, we won't have all the answers at all times, but I'm certain even if we don't have the answer on the call today, that we can get the answers. So, even for those that we, are unsure of, we'll follow up after the call and we'll circulate that question to the group as a whole too, just so that everyone has the same information. So our agenda here today, we're going to start out with what we've learned thus far, right? So we're 6 months into the year. We've gotten a lot of information. There's a lot of public filers out there that have filed and have been through a little bit of the rigmarole in terms of what to expect. And so we've learned a lot from that process, from the industry as a whole, various sources, things we've taken on and come to find out in terms of the pains and the nuances with adopting the standard. And then after we go through that, we're gonna, somewhat selfishly talk about preparing for audits. Some of you have already been doing so. I know a lot of the CECL implementation work we're trying to get a head start on to avoid some of that compression come to the end of the year. But, the overall audit will still, be in that last quarter of the year and into the first quarter of next year. And so there's a lot of things to get done between now and then. So we have a lot of information in those, that portion of the slide deck where we will sort of cover those items and things that you should be thinking of now if you haven't already. Followed by that's where I'll switch gears and change it over to Jamie to give you the interesting part of the presentation, which is CECL disclosures. And so while we understand that, they may have sort of been side tabled as implementation was going underway, maybe in the back of the mind as you made sure you had appropriate reporting and whatnot, but the CECL disclosures are robust. I just got a draft copy of a set this afternoon, and it's 20+ pages. And while all institutions might not have that many, it just gives you an idea of how much is going into the disclosures, and a healthy portion of them will be different from what we're used to. So, we'll have that portion there, and then as I mentioned, we have submitted questions that we'll talk about at the end. So looking at what's next, the first thing is we understand all of the work, the hard work and efforts that have gone into implementing, the standard. It's the most robust standard that's hit financial institutions, certainly in my lifetime, probably everybody's lifetime on this call. And so while it must be a sigh of relief to finally get it implemented, we're 2 quarters in. The hard thing is that the work's not over. The models, while robust, there's a lot of factors in them that are part of estimates that are being put in. There's a lot of assumptions that are made in the models. I think we started off a long time ago thinking like qualitative factors, we might be moving past them quite a bit, but as most have found out, there's certainly still quite a large portion of the modeling and an important part of that process. And then, the key buzzwords that you've probably heard over and over again are reasonable and supportable forecasts. So, That's something new that a lot of us and a lot of our institutions, maybe didn't have to take into account before. And I mean, forecasting's tough. If you had a crystal ball and were able to forecast perfectly, you probably wouldn't be sitting on this call today. You'd probably have better things to do with that information. So, revisiting those forecasts and ensuring that, while not perfect, and no one's going to be perfect, whether the forecasts that you utilize were too aggressive, too conservative, whether they needed to be slightly adjusted, and that, again, you're continuing to be able to support them, because as anyone can attest to, the economy is anything but certain right now. So I can imagine as we work our way through the rest of the year, more curveballs will be thrown our way. That will have, impacts on the industry and our modeling as we work our way through the rest of the year. So, the only thing I, want you to take away from this is that, these are very much dynamic, not static models. These assumptions, again, they should be thought of as, a moving target as things, adjust. So I would say we would expect at minimum quarterly institutions are revisiting these. It's probably uncommon to see it done, very robustly on a monthly basis. But quarterly is probably a good touch point, and then at year end, very much make sure that those things are hammered out, and all of the information related to them is sort of concrete at that point.
And I
The
think too,
next,
Kevin,
yeah,
as you're kind of debriefing, through this year and making sure your documentation's in order and so forth. I know we've worked with a lot of people that may have implemented it not necessarily the way they wanted to initially because of certain restraints they had on data, time, whatever it may have been. So to continue to accumulate data and see if you can continue to refine your model to what you want it to be as you move forward.
yeah, absolutely. I mean, a lot of historical, data is being used, peer data is being used, making sure you have the right group or the right peer group. We're going to talk a little bit about that when it comes to the audit portion, in terms of the importance of some of that information, and especially when it comes to the relevance of that data to your specific institution. So definitely key factors that should be, being taken into account as we move our way through the year. The next thing we have on here, technically, again, should have been in place 1/1 when the standard was adopted, but we understand the reality of how the world works. And so, the internal control environment is an area a lot of institutions need to make sure that they focus in on, and ensure that they're understanding the changes to their control environments. Because especially when we get in there, and as the regulator is going to get in, or getting in there, we're going to want to understand, how did you update your control environment and the controls, surrounding the allowance for credit losses. In some instances, it might be a change to an existing control, a design of it, and how it works and how it's functioning, and in relation to your assumptions and the modeling that's being used. But there's going to be a lot of times where you didn't have a control previously. There wasn't a key control identified necessarily, especially for those using third-party solutions. Because in the past, most of us weren't using third-party solutions. We had in-house, modeling that we used, Excel-based and other formats, but with that comes with new control considerations. And I, have over here, controls over data are key. I mean, that is going to be the precipice where we're focusing a lot of our time, because, your calculations and your modeling and your methodology are only as good as the data behind it. So if there aren't firm controls over that data, and specifically, the buzzwords, the completeness and accuracy of that data, well, then that's probably going to be a deficiency in your environment, and you really want to make sure that you're taking a look at those. And that's, an area we're happy to chime in if you have questions, comments, concerns, about, particular control setups. That's why we're, here to sort of give guidance where we can, and sort of let you know what we've seen. And so it's just an area, again, I don't want it to be an afterthought, which I'm sure it will not be, but it's an area we want to make sure we keep our focus on as the year is going through. The last thing I have on here, again, items 1/1 were part of the adoption, but at the same time, with the main focus on, the main modeling for your loan portfolios, these items tended to sort of take a, center stage left, if you will. And so those relate to debt securities, purchase loans with credit deterioration, and unfunded commitments. So when it comes to the purchase loans with credit deterioration, there is a lot of nuances and a lot of information that probably could fill, a couple hours worth of, dialogue. That being said, we understand it's not generally the case. Many of our, institutions have these. So we're not going to spend much time on them today. None really, other than me, bringing it to light. That being said, for those of you that do have them out there, as you're working through that process, we are happy to discuss them. Reach out to your practitioner and we will, guide you along the way. But debt securities are something that every one of our institutions have. And I think that, a lot of them are thinking of them as almost an afterthought in terms of, adopting CECL and implementation of the changes that the accounting standard requires. And I will say, in most instances, yeah, it is not a significant change based on the composition of our bank's portfolios. But that being said, it's still important, and it's going to be asked for by both us and the regulators, a memorialized or documentation of the processes that you've undergone to ensure that the credit risk in your investment portfolios is appropriately captured. And that, applies to both the held to maturity and available for sale securities. They are covered in different sections of, the CECL guidance, but they both are impacted by the adoption. And I know, again, a large chunk of our portfolios are what we would consider very little to no credit risk, treasuries, municipalities, etc. But that being said, it doesn't, preclude you from having to document your process and document why it is there are no or little risk associated with those and why they're not being taken into consideration in your allowance. And then for the portion of portfolios that, do have credit risk, whether it's corporate bonds or what have you, you're going to have to assess those for any potential credit risk. And again, maybe the answer comes out to zero, but it can't be just, verbally. It should be documented, memorialized, part of your process as you review these things, similar to, our old OTTI analysis. An analysis should be being performed and documented and supported appropriately. When it comes to
Kevin,
yep, go
just
ahead.
to chime in on that one, I think the nice thing that we've seen that some of the third-party bond accounting providers have been providing that information, but again, kind of coming back to like what we've been talking about for a long time with the CECL models is that if your bond accounting provider is providing that information to you to make sure you understand how it's being determined so that you can support that when you're talking to your auditor or your regulator.
Yeah, good, very good point. So, shifting gears a bit to the unfunded commitments. This is, another area. Again, I know it's on everyone's radar, but outside of those unfunded commitments that are sort of scoped out, and that's those that are unconditionally cancelable, where you wouldn't have to take into consideration a potential credit loss reserve. The rest of it you will. And again, that might take some information that you're not used to compiling or maybe don't have robust historic information on, such as, the likelihood of funding occurring and the estimated amount to be funded over the remaining life for those unfunded commitments. Those are, significant estimates that, need take careful thought and consideration in determining. And then it could be, depending on, your respective portfolios, it could have an associated significant liability with it. So it's something we don't want to lose sight of. It's certainly something we've seen sort of be a hot topic when it comes to, early on regulatory reviews, I'll say, and especially in the audit world, it's an area of higher risk given the level of estimation involved. And thus it's an area we're asking about when we're on site. So going on to the next page. So those of you that were able to join us earlier this summer, we had a rather robust webinar on ASU 2022-02, which, if you're unfamiliar, that's the guidance that came out after CECL that eliminated the TDR guidance that we all knew and loved. So sad to see it go, but happy to hear that it was replaced with new disclosures to keep us busy. So those disclosures surrounding modified receivables, modified receivables are not a new item. They're something that have existed in the standard for a long time. That being said, the disclosures associated with these modified receivables, specifically to those that are experiencing financial difficulty, are new. And some of them are similar to what we've experienced with the TDRs and what we've historically, disclosed, but they're not the same. And the definition for those experiencing financial difficulty is not exactly the same as TDRs either. Now, I'd suspect most TDRs would now fall under the umbrella of those experiencing financial difficulty, but there are nuanced differences to what does and doesn't fall into scope of that. And so it's important, to be setting up your systems and setting up your reviews and whatnot to be able to capture this information appropriately so that you're able to track them and retain the information necessary to do the disclosures, which, we have outlined at a high level again up here. Happy to, provide the slide deck that we did earlier in the year related to that, where we go in quite a bit more detail, quite a bit more robust in terms of the information included in there surrounding this. But if you have not taken this into consideration yet as you're working your way through the year, now's the time. Certainly not a process you're going to want to be doing at the end of the year as everything becomes more and more compressed. Lastly, what we've got here is regulatory exams. So, new to all of us on the call here, the OCC, the FDIC, et cetera, are going to be beginning to ask questions over the modeling if they have not already been asking questions. And so as they go through these exams, it's going to be important that you're prepared for them. So, not only from an external audit such as ourselves, you want to make sure that you have all your T's crossed and I's dotted when it comes to these exams. And so just recently, actually, at the end of April, they released a new interagency policy statement on the allowance on areas they're going to focus in on. And so, this is sort of what I alluded to earlier when I was saying that, there's going to be an emphasis on fit when it comes to some of the decisions you've made. And so, as you can see here, emphasis on the model, fit, the reserve for the size and complexity of your institution. And so, to give you an example, the WARM methodology, right? It's an accepted methodology to be used by institutions. However, it's really meant for less complex, smaller institutions. So, if you're over $1 billion in assets and you're using the WARM model, I would expect it's going to be challenged. And so it's not only, something such as the WARM model versus another more complex model, but, the assumptions that you're using, the peer data that you're using. When you're talking about the assumptions that you have, third-party solutions such as Abrigo have great assumptions, right? But you still are the one selecting which assumptions for your model and making those determinations as to which ones are appropriate considering, your respective institutions. So, if you're taking a blanket approach and just grabbing them and trying to get, your model to just include, everything under the sun, I would expect to be questioned as to why these things are in there, why it makes sense for your institution. I think that the regulators especially are moving away from, a one size fit all benchmark type mentality, and they're really going to be focused in on, does your modeling, does your method, do your assumptions really make sense for your institution? And then lastly, adequate documentation, right? So as obviously as an auditor, I love good documentation. Regulators are no different. If you are supporting your processes and your decision making and so on and so forth with good documentation, I think that you'll find that they are more agreeable. Even if you have a sound reasoning, if the documentation is not there, I again suspect you will be challenged on it. And again, if you want some light reading, we have a link down there that you can go in and read the entire policy statement. It actually wasn't too awful long, but that 3 bullet pretty much summarizes what it involved.
And Kevin, I believe from what we've been seeing and hearing through 2023 is that although the regulators are in, they're not necessarily looking at it, and we almost feel like they're waiting for it to be audited, either by your internal or external auditors. And does anyone else want to comment on that? But that's basically what we've been seeing.
All right. Well, again, feel free if you think of something or want to chime in at any time. But going on to the most important part of this presentation, which is preparing for audits. So that previous bullet on adequate documentation was the perfect segue into what we're going to discuss next, which is documentation, right? Documentation. The first, second, and third most important thing that we're going to be looking for when we come on site. And so while the initial focal point of getting through the implementation was ensuring, your modeling was appropriate, calculations were complete and accurate, what is it that you should be focusing on now that those things are in place? And so the first thing I would, stress is accounting policies surrounding the allowance. They need to be updated. It shouldn't be the same as previously. There's very few modeling that is going to be consistent with what you previously had for this type of documentation. So we're going to expect, the accounting policies surrounding your loans, investments, data captured, so on and so forth, is going to be updated to reflect this, change in methodology. This includes updating your allowance memos, the quantitative and qualitative support for your assumptions made, and then again, the reasonable and supportable forecast. So that's one area where it becomes more challenging because, again, when you're making a forecast, it's all estimates. But whether it's a third-party solution as Abrigo, I think they provide some pretty robust documentation when it comes to a lot of these factors, or something more internally based. It's something we're going to need, and we're going to push on it if it's not adequate to sort of support the decisions made. And then when it comes to that documentation, you should be prepared to explain which calculations were made, what methodologies were used, why they were elected. As part of CECL, a big focal point has been the portfolio segmentation. And so a lot of our institutions, we didn't see, necessarily significant changes, but we should understand why that is, why it is that those were still appropriate under the new standard. If they changed, why they changed, and why they're, appropriate now, how that information is being compiled into those pools appropriately and accurately. And then if you, opted to use different methodologies, because the standard does allow for you to do so, for the different types of pools based on their risks and characteristics and profiles, what methodologies were used and why. And if you use the same for all of them, why that's appropriate. So, things to keep in mind that, sort of maybe were taken for granted or not necessarily well documented in the past are things that we certainly need to take into account going into this year end. The qualitative factors used, right? So I mentioned that, qualitative factors at one point were thought to be, lesser of importance, but, as we all have seen as we worked our way through this process, they are certainly just as important as they ever were. And where we have found that, a lot of the fall downs are in terms of qualitative factors are the appropriate documentation, not just supporting, them directionally and how they're moving and trending, but also the magnitude. If you change something by 5 basis points, well, why not 10? Why not 2? Well, what's the mindset behind that? What's the driver behind that? And we're going to be asking these types of questions to just gain a better understanding to ensure we, are able to ensure that those are appropriate based on your model and that they moved appropriately based on the underlying factors. And then again, not to beat a dead horse, but changes to the control environment. So, those are the important areas that we're going to be taking into account, and a weak control environment around CECL, is going to significantly increase the risk associated with those calculations and result in more headaches for all. So adequate documentation over those will be key. So going on to the next part, this part's, really dedicated to third-party solutions, and mainly because many of our clients have used them. And then, this is definitely a change from what the past calculations were done. So while these third-party solutions are fantastic, happy that many of them provide, robust documentation surrounding their methodology, their calculations, their assumptions. Some of them don't provide that without cost. So, if that's something you haven't looked into yet or had discussions with it, it's important to do that now. I think that, again, I keep on using Abrigo as my example, but what we've found is Abrigo has, pretty significant and robust documentation surrounding a lot of the things I've touched on today. In addition to that, has your third-party solution, done back testing, validation testing on your model to ensure that it's appropriately, calculating the information, and that results of that testing, is that made available to you for us to then assess as part of our audit work. And then lastly, does the vendor have a SOC 1 preferable or SOC 2 report? And specifically when it comes to those, not to forget that it's not just the fact that they have a SOC 1 report, but that those controls that are identified in that report are commonly, user entity controls or complementary user entity controls, that they are appropriately implemented at your institution and that they're operating and designed effectively to ensure that we can then place reliance on that report. Because without those, the report's great, but if you're not doing the controls on your end, it makes us unable to sort of rely and needs, results in more testing and more scrutiny and so on and so forth. So again, when it comes to these, be prepared that we're going to ask for, both the internal memos that the vendors have provided, but, somewhat more importantly, your own memos associated with those. So while it's great that they do provide that robust documentation, we still need to be able to understand why it applies to your institution, that it's still your responsibility to substantiate, what information was used, what modeling was used, what assumptions were used, why it's applicable. So while those memos are great. Don't forget about that last part. It doesn't need to be a novel, but it, needs to be something to sort of bridge that gap, right? For us to sort of piece everything together. Same thing when it comes to pure data. A lot of our modeling is using pure data. Relevance and applicability thereof is the peer group that you utilize appropriate based on your institution and the structure of it. Or if not, what changes need to be made in order to make it appropriate. So I think, especially in our regions, we have very similar, I would say financial institutions, not that obviously you guys are all the same or anything, but that they are relevant, but are using downstate institutions when you're an upstate firm and so on and so forth. And so, something that not a significant lift, but something that you might not otherwise be thinking of. And then, again, while we gain comfort over the calculations and whatnot coming out of the model, based on the factors I previously noted, it's still important to understand that, without appropriate inputs, the output is meaningless. So we will be focusing a lot of our testing and our time and efforts on the completeness and accuracy of those inputs that the bank has, put into the various solutions to make sure that what's coming out on the other end is appropriate and addressing all of the requirements under the standard. So I previously mentioned, again, the documentation over different loan pools used and, beating a dead horse here, but internal controls, very, very significant part of the process, end to end. And so with that, I will kick it over to Jamie.
And Kevin, just piggybacking on that a little bit, I think too, with the third party solution, there's a lot of like groups where there's a sharing of information and so forth. And again, like you were indicating, just taking into account if you're borrowing someone's policy to make sure you're tailoring it to your own and not including things that aren't necessarily relevant to how you're running the model. So moving on to the CECL disclosures. I guess first and foremost, the biggest thing that we noticed when we were looking at first quarter implementation of it is that just to remember that the vocabulary has changed. So in your disclosures, your comparative information will be referring to things that are no longer referred to in your current year disclosures. So impaired loans, those are now expected credit losses, your ACL now versus your ALLL previously, your allowance for credit losses, it was your previous provision for loan losses. And again, that's bifurcated now into different pieces on the P&L or in the footnotes to the financial statements. And then lastly, as we've talked about several times, you're not going to see the TDR indication anymore or disclosures. Then now you're going to have disclosures about loans that have been experiencing financial difficulties. Before moving on to debt securities, I think the other thing that I also just wanted to point out was, so obviously we talked about the face of the balance sheet. It should look very similar in nature, except for the change of the language. Income statement, where you previously had the provision for loan losses, you have the allowance for credit losses, and breaking it out by loans, securities, and off-balance sheet exposures. And then the statement of shareholders' equity, much like when you recently adopted the leasing standard, if you have an adjustment, that's where you're going to show the adjustment that you had as it relates to the adoption of the new accounting standard. And then lastly, the provision for cash flows, it'll just be the change in the allowance for credit losses versus the provision for loan losses that was previously captured there. And the other thing that we don't have captured in these next couple of pages is the policy note. I think that's going to be one of your bigger lifts heading into preparing your financial statements. And you can piggyback off of what you did for your memos for adoption and your policy updates that Kevin was just talking to you about. But obviously, everything's going to be overhauled as it relates to how you were determining your old allowance for loan losses and now your new allowance for credit losses. So your policy notes are going to all need to be revised as it relates to any type of impairment, as we're talking about it, as it relates to the standard. As it relates to debt securities, so again, these are presented net of the allowance for credit losses. There is a component for credit loss expense, as I mentioned before, and it's either recognized in the P&L or in OCI. I just mentioned that we have to update the accounting policies for that. As it relates to footnote disclosures, there's not, I'll say, a significant change, in my opinion, as it relates to the disclosures, except for if you do, in fact, recognize credit loss. So then if that's the case, there will be a roll forward similar to what you were doing with the loans. You'll do that now for the investment securities. And then you'll also have to indicate how you determined those losses were present. So there'll be qualitative disclosures about how you got to that point. So what else changed? So some of the either cut, kept, or modified disclosures. Impaired loans, obviously, if the word's going away, that disclosure is going away. TDRs, that is now debtors experiencing financial difficulties. If you take a look at the examples, which we'll talk about on the next slide, they look very similar in nature to what was there previously. And as Kevin alluded to before, we put out some information on that in the fall, and we also talked about it at one of these CECL roundtables. The biggest lift, in my opinion, is for the PBEs and these vintage disclosures. We did work through these with the SEC registrants for the quarter ended March 31st. And it is a lot of work to get this information compiled. And the other thing, again, just to piggyback on what Kevin's already talked about, it needs to be auditable as well. So I think that's the biggest thing, is making sure that you're leaving a very good trail of how you're getting that information accumulated for disclosure in the financial statements. So if you are in that boat where you do need to prepare this disclosure, I think it's something you want to start thinking about sooner than later, because it is fairly challenging in nature. As Kevin alluded to before, the purchase loans, it just changes to the credit impaired model. And then there are some, disclosures surrounding that. And then lastly, the enhanced importance of the expected losses moving forward, and the difficulties in explaining those uncertainties. So again, that to me comes back to the policy disclosures. So what do we have to offer? So we have been working, and Kevin alluded to a 20-page example sitting on his desk. We do have example disclosures that will be available on our CECL landing page in July. So you'll receive notification about that, and it will be comprehensive in nature. So there'll be example policy, what the face should look like, the investments, as well as the unfunded commitments and loans disclosure. So it should be comprehensive in nature for you to leverage. You can always reach out to any of your Bonadino or Bonadio audit team members as well. So why don't we roll into the questions? Kevin, do you want to grab the first one?
Yeah, sure. So as I sort of talked about earlier on, the reasonable and supportable forecasts are, a big topic of conversation. And so first question relates to those. And so reasonable and supportable forecasts are a significant assumption in the standard. What would you say most institutions are using for their forecast period? And so as I talked about earlier, the longer you get in the forecast period, the less likely it is to have any, semblance of accuracy to it. And so what we have seen is most forecast periods are rather short, a period of 1 to 2 years in most institutions. The larger the institution, the more likely it is that they'll have a longer period. But I would say I have not seen any, and it's very uncommon to have a period, 3 to 5 years, because in terms of, again, the supportable aspect of it, it might be reasonable, but how are you going to support it? How are you going to ensure the auditors and regulators that 5 years from now, the information that you're used is appropriate? And I think given our most recent economic uncertainty we've had, it becomes even more the case that the shorter the period is probably more appropriate. And then, the other thing not to forget about is when it comes to that, the reversion back to your historical data, right? There's a couple different approaches you can take. So a lot of times the software is doing that for you if you're using a third-party solution, but if not, reversion back to the historical data and how this is achieved is an important aspect once you get beyond that forecast period. You want to do this one, Jamie? Or
yep, sure. So question number 2 was about loan segments and whether or not they should have changed under CECL and how granular they should be. In more instances than not, we've noticed that they have not changed significantly under CECL because you are already looking at loans under common risk characteristics. And the other thing is too, a lot of people are using, if you are using a CAN product, 9 times out of 10, it's using the call reporting data, which is also similar in nature to what you've already been doing. And yeah, we do have a word of caution here about if you go too granular in nature, that may not be best suited to predicting future losses either, because either you may not be able to find comparable data, or the data you have may be insufficient in nature. So again, I think, making it at a level that is reasonable in nature to accumulate and evaluate losses is what's appropriate. But yeah, we have not seen a lot of change there.
All right, so for question 3, we have, in utilizing our historical loss data, the expected loss rate is very minimal. Does this mean my ACL should mirror this information? And so, as many on the call I'm sure can attest to, when you look at just purely your historical loss data, if we were to base our allowances on that information, we would all have very small allowances. Prior to CECL, this is a rough estimate, but I just put 1 to 1.5% of total loans was a common amount of the allowance to total loans. If we were to use historical loss data solely especially for the regions in which our banks operate, that would be half of that, if not even smaller, right? So that's where, as I mentioned multiple times earlier, the qualitative factors are certainly still allowed. They're appropriate given, again, what is going to be taken into account to forecast out appropriately. It's just that there might be a little higher level of scrutiny on them. It's not a given in all circumstances that all qualitative factors will be in there. It really should be taken into account based on your particular institution, the market, the economic environment that you're in. As noted here, the 2 most common approaches we're seeing are discounted cash flows. That's probably the most popular model I've been seeing being used, and then WARM modeling. Both of those are heavy on the qualitative factors and making those estimates. And so again, we expect that institutions will continue to use that and that type of external information to help get their allowance to the appropriate amount. But historical loss alone will not be it. And then again, I'm gonna say one last time, significant documentation around it is the key when it comes to methodologies and assumptions used in that process.
From what we've seen so far, I believe the biggest challenge has been 1 to 4 family with this area, where there's been minimal or 0 losses being captured or determining as the loss rate for the models. And that's where we've really seen people have to challenge the Q factors as it relates to those, to ensure that they're being adequately reserved for. So the next question is, can I wait to record the impact of CECL on my deferred taxes until year end? So the answer is no. This is a day 1 adjustment. So again, knowing that your tax rate can fluctuate depending on numerous factors. So even if you're going to be booking your entry at the end of the first quarter, you have to take into account whatever your effective rate was at the beginning of the quarter, or whatever you anticipated your effective rate to be for the year. So you should not be waiting, and especially since the tax rates are fairly significant, this could be material in nature if you didn't book it on day 1.
And our last of the submitted questions is, since it is difficult to know our quarter end CECL calculations until, partway through the following month as you're accumulating that data, is it okay to use the previous month's CECL data in filing the call report? And so, this is a sort of yes and no question, and that, yes, it's appropriate because given the deadlines that are associated with these, we understand that it's impractical for all the information to be compiled to be able to appropriately update your CECL calculation prior to filing the call report. That being said, significant material changes in that month period cannot be ignored. So if you are aware of something that would drastically change those factors, you can't fall on, back on, well, we don't have enough time to make the updates. You would have to take that into consideration. That being said, most of the time we would know about those ahead of time, or they don't often occur. So in the long run, it's generally appropriate to be able to leverage that information to make sure you can get things out the door quickly, but to keep in mind that significant changes need to be taken into account.
And I think from what we've seen, Kevin, as well, that I think throughout the year, other than at year end, I don't know if people will always be holding their books open to be using the current quarter year or current quarter end model data. I mean, I think you would definitely apply the loan balances and so forth. But as it relates to the loss factors and some of the qualitative adjustments, I think that it's reasonable in nature to, as you've indicated, be reasonable about it.
All right, and that I think is the last of our submitted questions. So I know we've been talking up here a while. We'd be happy at this time to sort of take any questions you have. In terms of I'd like to point out too, on this last slide here, we have our CISO resource webpage. So a lot of good, useful data on there. If you haven't been there yet, please, take a look. A lot of information that I think will be, beneficial for you to, get through this process in addition to, working with us. But outside of that, I'd open it to any questions or comments, that you guys might have.